Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead.
Hello, everyone. Thank you for dialing in to the Barometer Readings monthly conference call. My name is Sarah Petoskey, Regional Vice President of Sales at Barometer, and I'd like to thank all of you for your continued support. This call today is very timely, given the recent market volatility and our constructive outlook on the market. Today, David Burrows, President and Chief Investment Strategist, will discuss some of the short-term market disruptions and how we implement our process to manage through these current markets. With that, I'll turn it over to Dave.
Hey, folks. Thanks for taking the time today. We thought this would be a particularly timely moment to have a conversation about current markets, a quick revisit to process and how we kind of try to work our way through a moving market, and then the upshot, talk about sort of where we see things going from here and sort of how we're positioned. Most of you have heard us speak several times about the process that we use to make our decisions, but as a quick reminder, the basic view is that 80% of return comes from finding the asset class that is being revalued positively versus the others and focusing in that area. Second, within that asset class, finding sectors or themes where there's some natural tailwind that could cause those sectors to be revalued versus their recent history favorably. And then the third thing is within those themes, trying to identify the gorillas, the companies or leaders that have something changing for the better that can allow them to be revalued versus their peers. So it's always a moving target, and we spend a lot of time in our top-down process to try to track ultimately where the money is going. Where is money getting put to work, and focus in those areas of leadership. I think as most of you know, we have been fairly bullish over the last 2 years and have continued to be bullish over the last while with a view that we began in 2012 the early stages of a revaluation of the equity asset class after 12 years of contracting earnings multiples from 2000 through 2012. And a ramp up in correlations. Watershed in the fall of 2012 started seeing multiples expand again, along with earnings growth, which could lead to outsized returns. And so the flows that steadily moved away from developed market equities between 2000 and 2012 in favor of moving to real estate and emerging markets and commodities have been reversing. And this is a process that will play out over many years. So the characteristics of a secular bull market tend to be falling correlations. Correlations have fallen from over 90% to roughly 55% over the last 2.5 years. You tend to get short, sharp corrections that lack significant magnitude or duration, as opposed to the corrections you get in a secular bear market. In other words, they're shallower and shorter. There is cash on the sidelines, generally waiting for opportunity to come in. And there continues through a bull market to be skepticism about why it is that multiples could possibly be expanding. So, as you know, we've gone through we went through the third quarter, which seasonally is the weakest period. We talked earlier in the year about the fact that when leading economic indicators are improving headed into the third quarter, there's like an 88% chance of a positive quarter with an average return of 5%. Third quarter was positive, and leading indicators were improving. We headed into the weakest period of the year, end of September, beginning of October, and we saw some disruption. So I want to talk about how a correction unfolds because, near-term examples are always great to learn from. We often talk about the fact that you see weakness first in the weaklings as people lose confidence, and then selling spreads. We know that for the last 18 months there has been relative underperformance in commodities, relative underperformance in Canada, relative underperformance in emerging markets. And through the spring of this year, we started to see a little pickup, early summer pickup in the weakness in commodity prices and general underperformance in emerging markets as the U.S. dollar really began to rally. Now, from an interest perspective, all the way through the 90s, the U.S. dollar appreciated versus the basket of world currencies as money moved into the U.S. stock market. People were buying dollars. From 2000 through 2012, U.S. dollar index fell versus the basket of world currencies as money rotated away from developed consumer-led economies. And over the last 18 months, the U.S. dollar went through a bottoming process and began to head higher, and through the summer, much higher. That big move in the dollar put pressure on emerging market currencies and emerging market stock markets. It put pressure on commodity prices, and money began be more focused in developed markets. Now, I think there has been a view that Europe was much like the U.S., although a little further back in the recovery. And through the summer, as you saw weakness in commodity prices and very low inflation, I think concerns started to rise that the recovery in Europe was stalling. And because of the fact that they really haven't recapitalized their financial system well relative to what's happened in the U.S., and because debt levels remain very high, deflation or disinflation would be really negative in a world where you're trying to balance off your assets versus your liabilities. If asset prices start to fall, that could be a problem. So you saw selling spread to European markets first in periphery, then into the core. U.S. market continued to be strong until the fall of this year, made new highs, but eventually, in any period of time where you see deterioration in breadth in financial assets, you come back and start to hit the leaders. We had energy, which was the one commodity that had held up over 18 months, start to crack. We saw it move from $100, start moving lower sharply. I think that that started to impact some of the hedge funds. So as a step back, hedge funds in general through this year had well underperformed the market, and they had several big leveraged bets. One of them was on energy in particular. If you looked at the survey of expectations for energy prices in the month of July, fewer than 3% of money managers thought that oil could go to $80. Most of them were making bets on higher prices. So you saw a selling pickup in energy. That started to impact hedge funds around the same time as CalPERS announced they were exiting their investments in hedge funds, sending out significant redemption notices. You had a number of hedge fund bets blow up. You had the Fannie and Freddie bet that they made on a ruling that there would be equity left for the stakeholders go against them. You saw the recent blow up in the Shire AbbVie mergers and acquisition deal. There were lots of leveraged bets on MLPs in the U.S. looking to pick up yield. And so selling picked up. Now, ultimately, we saw our short-term indicators turn down in September. We had come out of our energy producers through the early summer when our breadth model turned down the end of July. We came out of them through the end of July and August, leaving only our energy infrastructure. But through the end of September, beginning of October, ultimately you do get to a point where you start to see liquidation take place. So you had a lot of leveraged investors in Fannie and Freddie in energy. You had PIMCO manager change, so there were redemptions and bonds came for sale. Investment dealers in general have gotten out of the inventory business, so there was limited liquidity there. And by 2 weeks ago, we were seeing margin calls at the end of the day. So this is how things unfold. And in our process, we stay in our positions so long as they hold trend. And that's not to say that stocks can't pull back within trend. I mean, that's a natural thing. You have markets, stocks that move higher, and they correct within trend. That's perfectly normal. We had some people say, well, should your stops kick in right away? Well, frankly, our stops aren't 2% from the highs. We identify where we believe trend is changing in a security or behavior is beginning to change. And certainly we always have our stops. Interestingly, the majority of sectors that we are invested in pulled back within trend, did not break down. The majority of stocks we own pulled back within trend, did not break down. But certainly we saw some. So ultimately, I think things came to a bit of a crescendo 10 days ago on quite a lot of forced liquidations in hedge funds. The one group that we are in that did get impacted at that point was energy infrastructure, which is the least correlated part of the energy food chain. I'm going to get Sal to talk a little bit about that. But ultimately, we got to a point where our short-term indicators are very sold out. So I wanted to talk a little bit about what we look for short-term bottoms or market bottoms. First of all, we look at 4 short-term indicators, and those are included percent of stocks trading above the 50-day moving average. That indicator from July moved from 80% to a low a week ago of 16%. So only 16% of stocks had held their 50-day moving average. That's as low as it's been in 4 years. Percent of stocks trading above the 150-day moving average moved from 74% in July to 22% as of last week. Percent of stocks hitting new highs versus new lows went from over 80% to 14%, the lowest level in 5 years. And the percentage of stocks with positive price momentum went from over 70% of securities to just over 12% of securities. So those are all extreme sold-out levels. And so we made some comments at the end of last week, I think that went out on Monday morning, talking about the fact that our short-term indicators are extremely oversold. It looked as though we should be nearing some kind of short-term bottom. So what do we look for when we start to get it? First of all, 1 day is great. We need to see at least 2 days of significant volume and significant percentage point move. The first day sometimes could be short covering. A follow-through day where you get significant volume and significant percentage point move with very good breadth will tend to be a confirmation of those lows. Well, certainly today we had that. S&P had its biggest day in a year. Out of the S&P 500, 483 stocks up, only 17 down. One of the leading indicators we look at, semiconductors, were the biggest moving group, up 3.6%, indication of expectations for future economic activity. NASDAQ, which has led all the way through this rally, up 2.5%. When we look at the sectors that we have been focused in and continue to focus in, healthcare made a new relative strength high today, moving the high it put in at the market highs. Transports also hit a new relative strength high today, and some of the consumer sectors hit a new relative strength high, including the retail sector. Financials stayed strong all the way through the decline. Certain parts of technology pulled back, but have come charging back and have followed through nicely. So our key sectors across our portfolios have been and continue to be financials, consumer discretionary, technology, healthcare, and energy infrastructure. So let's just talk about energy infrastructure for a moment. Energy infrastructure stocks, which include the companies that transport, process, and store energy on the way from the ground to the market, held up until 3 days from the lows in the market. And in that last 3 days, there was significant selling. We believe, based on the fact that there were liquidations being forced and margin calls. One of the things we look for is, what is the last group to break down, and then how does it behave on the first sign of strength? So just as an example, if you have an opportunity, pull up the chart of AMLP, which is the ETF that invests in master limited partnerships in the U.S. energy infrastructure. And AMLP went from just about $19 to $16.25 in 2 days, and recouped all of that in the next 2 days as buyers returned to the market. So a strong sector should, if it does eventually get caught up in a sell-off, when the sell-off backs up, rise back to the surface like a cork. And that's exactly what we've seen in all of these energy infrastructure names. So there's good fundamental reason for that. I thought maybe Sal could join us, Sal Malik, who's one of the core managers that we have in the income strategy and are in a long short. to talk a little bit about why it is that energy infrastructure can behave very differently than the energy sector as a whole, and why we continue to be bullish on the group.
Hey, thanks, Dave. Hi, guys. So I guess I just want to give you an overview first in terms of how much money that we do spend on the oil and gas production within Canada. For 2014, in Canada, we are actually spending around $45 billion. And the key thing is, within that amount, almost $26 billion is being spent on oil sands. And the thing about oil sand is that once you start a project, you really cannot stop it. And these are like 30 to 40 year long projects. And from all the analysis that we have done, if oil prices stay below $70 for a year or year and a half, at that point you have to get concerned that people will start thinking about cutting these projects. And the interesting thing is, when you look at most of the oil sand projects in Canada, they are in very strong hands. You have companies like Suncor, companies like CNQ, Chevron that are focused on these projects. So the reality is, when we look at these midstream companies, what they have been doing in terms of interpipeline, that is, has a pipeline that takes the condensate to the oil sand projects, or if you look at Keyera and Pembina, that have these deep cut facilities that allow natural gas companies to split the NGLs into condensate and propane and butane, because you need all that diluent, the condensate, to move the oil sand production through the pipe. We believe that the demand is going to be there's sustainable demand for the next 10 to 20 years, as long as oil is between the range of $65 to $80. And given that all these companies have contracts that are that go out almost 4 to 6 years, so their cash flow growth is already locked in, and the counterparties again are top-notch counterparties. So in our opinion, that when you're looking at the midstream companies in Canada, you're playing the growth in production, more to say than the increase or decrease in price. And given that these are long-term projects, we believe that there is visibility. And given that, the interesting thing is, over the last week and a half, the yield on the 10-year bond has actually come down by 35, 40 basis points, and all these companies yield 3.5 to 4.5% in terms of their dividend yield, and their free cash flow yield is around 6.5 to 7%. And the companies that we own are growing dividends by 10 to 12% over the next 5 years on an annual basis. We think they look more attractive, and that's why, as Dave mentioned, you have to observe when the market does start to recover, which sectors come back first. So we have seen the midstream space in Canada as well as in U.S. Have recovered quite well. Right. With that, I'll pass it back to Dave.
So ultimately, our view is that unless you thought that oil prices were going to stay down for a long period of time, and I think at this point it looks like it was more of a liquidity crisis in the short run that took them here, we don't see a change in view. Now, we certainly follow our stops, but ultimately these midstreamers gave up some of this summer's gains, period, and ultimately have held well and rallied back the other way. When we look at energy infrastructure in the U.S., and you look at where the high growth production gains are coming from, the cost of finding oil in some of the most prolific regions like the Bakken and Haynesville and so on, down at $40 to $50 a barrel, still way below where we are now. So we did carve out our energy producers through the summer. Frankly, our breadth models are very sold out on energy. You could see a bounce here. But the net of it is what we stayed with was energy infrastructure, which of all of the pieces of the energy food chain has the lowest correlation to the price of oil. So going back to why it is that we think that this is not a bigger deal than our indicators show. When we look at other measures of crisis in 2008 and 2011, credit default swaps on financial institutions blew out to wide levels. In other words, insurance to protect against default on financials got very, very expensive. In this pullback, credit default swaps pricing barely moved. So that tells you there was no real concern of a liquidity crisis in the market and that financials were in good shape. When we look at leverage, we know that leverage in the financials has come way down. A big part of the move down in 2008 was highly over-levered investors. That is not the case today. So when we go forward, we say, does it make sense? Where should we be putting our money? Ultimately, all of us have choices to make. We can own cash that pays us almost zero. We can own sovereign debt fixed income, where the U.S. is one of the highest yielding bonds in the world at just over 2%, or we can buy German bonds at 0.8 of 1%. We can buy corporate debt, which has the lowest spread or risk premium above what you can get in sovereign debt, lowest spread in the last 5 years. Or you can buy equities, where the earnings yield on the average company in the S&P provides a very substantial 3.5% to 4% premium over what you can get in a government bond. When we look specifically at the investments that we make, dividend payout continues to be exceedingly low, meaning corporations can continue to ratchet up dividend payouts. Dividends this year in the S&P will probably be up about 12%. In our portfolio, it looks like by year-end we will have close to 20% dividend growth. We watch for a continuation of what has worked up to this point, and we can see that consumer discretionary and financials continue to behave well. They have been leadership since the beginning of the bull market. U.S. dollar has had a little pause in the last 2 weeks versus yen and euro. In the last couple of days, has started to reassert strength. Yen and euro starting to back off again. We look at what followed through today. What followed through today was financials, healthcare, consumer, technology, and transports. These are the groups that we're focused in, and frankly, these are the groups that historically do well in the face of a strong dollar. Commodities. Commodities have had a very sharp sell-off. Can they bounce? Absolutely, they could bounce. But at this point, we would look at that as more a short-term issue than a long-term theme. They are likely to underperform for a long time. If you take the basket of commodities, as of about 2 months ago, they broke down the long-term trends that have been in place since 2001. So finally, I just want to revisit the 9 key factors that tend to be in place in order to get a significant correction in the stock market. Since 1973, the 9 key factors: a sharp run-up in the price of oil. Well, we certainly know that's not the case. A significant fall in the price of oil, very supportive to a consumer economy like the U.S. Second factor, a sharp run-up in short-term interest rates. Well, we know that that's not the case. A sharp run-up in long-term bond yields. We just hit very low levels for U.S. government bonds and the rest of the sovereign debt around the world. So we know that's not the case. Signs of an economic slowdown. The most recent economic indications coming out of the U.S. have been better in the manufacturing and employment and in home building. When we look at consumer euphoria, Michigan consumer sentiment, if it gets over 90%, that can be a sign of correction coming. We are well below 90%. When financials and consumer discretionary stocks start to lag the market, they are not lagging the market, they're leading the market. When you get significant multiple increases in interest rates globally, well, we know that's not the case. Or when you get international crisis. So as it stands today, against all of the major corrections going back over the last 4 years, anywhere from 5 to 9 of those factors were in place. Today we have 1. There are certainly international crises going on, things to worry about like Ebola and so on, but at this point we just don't have the factors in play. So here we are headed into the fourth quarter. It looks to us as though we've seen a short-term bottom in markets. We've had a follow-through day. Our short-term indicators have all turned up. The cash that was raised in that period of 2 weeks, we have been redeploying over the last 2 days. We have a small amount of cash in the portfolios. we've identified very good targets. Fourth quarter is the strongest quarter of the year since 1928. In 89% of the cases where the third quarter was a positive, you had an average positive gain of 8.2% for the fourth quarter. We often say we follow what is happening when we try and understand why. Our work shows in the short run all of the things that should be happening if this is a short-term correction are happening. So we continue to be very bullish. We think that there's a lot of cash that continues to be stranded on the sidelines. You could see today there was a stampede trying to chase this reversal in the market. Could we see a few more days of sloppiness? I suppose absolutely we could, but the evidence to us is overwhelmingly positive. So high income pool as of today is about 93% invested. The equity pool is roughly 95% invested. The sector weights haven't changed very much over the last while, and the portfolio has all enjoyed a very good day today. So we hope this is useful. It's no fun going through little corrections. I guess it's been a while since we saw a 6-7% correction in the S&P or 10% in the TSX. They do happen, but I would not expect to see significantly greater corrections in a secular bull market as we go forward. So I think another opportunity to add here. So hopefully that's useful. I'll pass it back to Sarah to wrap up, and certainly we're happy to take any questions.
So before we take any questions, I just want to thank you again for joining us on the call today. Our next Barometer Readings monthly conference call will be held on Thursday, November 27th at 4:15 Eastern Standard Time. Please do not hesitate to contact Nick Hamilton, Kayla Peacock, or myself with any questions. And with that, we'll open it up to any questions for Dave or Seth.